Welcome back to the Hollander Group podcast, where we talk about the ideas and strategies that help people make smarter financial decisions and build lasting wealth. I am Tricia Hollander Henning, and I'm joined by my sister Teri Hollander Albin. Today, joining us is Mark Eibel, CFA, Director of Client Investment Strategies at Russell Investments. Mark has over 4 decades of experience in the investment industry, having started his career at Russell Investments in 1984. Throughout his tenure, he's held a variety of leadership roles, including serving as Director of U.S. Equity Manager Research. Today, Mark serves as a principal spokesperson for Russell Investments. He regularly speaks at industry conferences and appears in media outlets such as CNBC, Bloomberg TV, and Bloomberg Radio. Thanks for joining us today, Mark.
My pleasure. That 4 decades thing is so hard to get used to.
It's scary, isn't it?
It
yeah.
is.
Well, we're thrilled to have you here
thank
today.
Thanks for having me.
As we look into 2025, or look at 2025, we've seen some surprisingly strong markets, really despite some persistent negative consumer sentiment. So how do you explain that disconnect? What's really driving investor optimism, and while everyday consumers still seem a little bit cautious?
It's one of the most fascinating markets maybe in my entire career because of that. Seeing consumer sentiment to be so different than market performance, usually they sync up more. When you're making money, you're happy, and when you're losing money, you're sad. So I think there's a lot of personal politics that is entered into this one, where even though markets are doing well, half the country probably likes politically what's going on. It's like it always is, right? Half the time you win, half the time you lose, and half still that I think has impacted the way that they're looking at markets. Markets have really been driven by 3 things. Number one, wealthy consumer continues to spend, particularly in the United States. The AI spend has been tremendous, and earnings have been good. So that has propelled this economy to the levels that it's at right now, which has propelled markets up. Markets are expensive in the U.S., cheaper everywhere else, which is maybe why it's been a nice run for stocks outside the U.S. this year, particularly.
Okay.
So Mark, the Federal Reserve recently made their first interest rate cut for the year, and they cited a softening labor market, but they also expressed concern for inflation or continuing inflation. Can you talk about their dual mandate and what the Fed action means oftentimes for U.S. economies and markets?
Yeah, the Fed has a tough job because of the dual mandate, right? It's almost as if you have 2 job objectives, but sometimes you can't accomplish one without failing at the other. And sometimes they go in sync. This has been a particularly challenging period because of the inflation that we had after COVID. So the Fed's focus was on inflation. Now inflation is getting down closer to be 3% or lower. They're pivoting towards the labor market, which is showing signs of weakening. It's an interesting time for the labor market because AI is already having an impact, particularly on entry-level jobs. So you have the supply being cut there. Immigration has cut the supply. Demographics has cut the supply. But you also have a period going on now where job demand is going down. So demand and supply are actually synced up okay, but it doesn't mean that there's not pressure on the labor market. There is a lower demand. So right now the pivot is towards focusing in on labor. Powell's job gets particularly difficult now because we don't have data because of the government shutdown. So the next Fed meeting that happens later this month will be a very interesting one on what he can and cannot do from a policy standpoint. He has signaled that he would like to continue lowering rates that they started last meeting, but will he have the confidence to do that in the face of he might not have data to support that between now and then? So interesting challenge, but the focus is definitely on labor, thinking that the inflation numbers are trending down lower. So continue to watch the labor market if you want to cue on what the Federal Reserve is going to do, not only in this meeting, but for the rest of the year and into next year as well.
Interesting, thank you.
Okay, and you talked about U.S. markets. You referenced the exuberance we're seeing in the U.S. markets. So because those markets are high, how do you feel about the valuations? Do you see specific risks? What risks do you see out there right now?
Yeah, I still think we're the best economy in the world, but you pay a price for it right now. And particularly when you look at it, including those 7 technology names that have really driven it. Even if you strip them out, the U.S. is expensive. So the rest of the world is cheaper. It's been cheaper for a decade. We've talked about this over the years. But I think there's some catalysts in non-U.S. markets' favor right now. Number one, they are cheaper. So, buy low, sell high. Econ 101. Number 2, you get a bigger dividend outside the U.S. Number 3, you get an offset to the technology and growth that comes from the US, you can buy a lot of cyclical and non-technology companies very cheap outside the US, and they're leaders in their field. And then the last one, which doesn't get talked about as much, is currency. The dollar has been strong for nearly 20 years, which is a headwind for non-US companies for a variety of reasons. We have entered a period of dollar weakness, which helps international. International markets like weak dollar. Emerging markets love weak dollar, and emerging markets are up nearly 30% year to date, and a big driver of that is simply because the dollar is weakened. So I think there's a reason to own outside the US. We're about 2/3 in the US, 1/3 non-US, and we're comfortable with that weight, but it's been nice to see something other than just 7 companies in the United States kind of determining the retirement futures of the world. It's been a nice year to see diversification really paying off.
Great, thank you.
Thank you, Mark. As always, your insights are thought-provoking and provocative, and we appreciate you sharing with them and with us and our listeners today. You've been in the industry, as we said, for over 40 years. So let's end with 3 key things that you've learned over time that you think are the most valuable.
Yeah, it's interesting. I'm starting to get asked this question more often than I did before. And as I've thought about it, it's not really, you have to invest this way, or this, you want need growth or value or US, non-US. It's the 3 things that as investors we actually control. We don't control what the Fed's going to do. We don't control earnings. We don't control the day-to-day, what drives the economy. What we control is, number 1, you have to have a plan. Number 2, manage your taxes for your assets that are susceptible to taxes. And number 3, and I alluded to it at the beginning, you got to stay in the game. Right? Markets go up over 70% of the time, and it's not always to stay in the game, which always goes back to the plan, right? And I think if folks just focus in on the time horizon that matters the most, isn't the Fed meeting every 6 weeks, earnings every 3 months, elections every 2 years, you have to plan for living 30 years after retirement. And if you can keep your eye on the 30-year time horizon, it helps you get through a lot of 6 weeks and 3 months and 2 years. So have a plan, personalize that plan, manage your taxes, and stay in the game. All of those are things that we can control. Markets have demonstrated over a few hundred years, they tend to take care of themselves over time. You've got to stay in the game to benefit that, to deal with the real issue, which is time horizon.
Absolutely. Great insights. Thank you so
Thank you.
much.
My
Mark.
pleasure. Thanks for having me.
Thank you.
This recording does not provide recipients with information or advice that is sufficient on which to base an investment decision and does not take into account the specific investment objectives, financial situation, or any need of any particular client and may not be suitable for all types of investors. Investors should consider the contents as a single factor in making an investment decision. All investments carry risk, including loss of principal. Past performance is not a guarantee of future results, and diversification does not ensure a profit or protect against loss. Baird does not offer tax or legal advice. Robert W. Baird & Company, Incorporated.